my name is George Hadger and welcome to this week's Video Insight. I want to spend some time talking about returns and how investors should interpret the investment numbers released by investment managers. This might be a controversial comment, but higher returns might not always be a good thing. Now that might sound counterintuitive. It's the point of investing is to make more money than you started with, but it underscores an important point. Returns must be considered in light of the level of risk taken to achieve them. High returns achieved through excessive risk-taking are likely to prove illusory with the passage of time. Let's consider a hypothetical investment manager that produces a 30% investment return over a one-year period. This is a solid number, but it says absolutely nothing about the risk taken to achieve that 30% return. Rather, investors should think about return per unit of risk taken, an important lens through which return should be assessed. Investors should consider the risk taken by the investment manager in three broad categories: portfolio leverage, portfolio concentration, and the idiosyncratic risk of each stock in the portfolio. Let's start with portfolio leverage. If the hypothetical investment manager is 2 times levered, then the return per unit of risk for that 30% return is far less impressive. In fact, a 10% unlevered return was achieved, with a 30% reported return created by taking considerable risk via financial leverage. Portfolio leverage is often disclosed by funds, and investors should pay close attention to the average leverage employed to generate investment returns. Secondly, portfolio concentration is another risk factor to be considered. The investment manager who achieved the 30% return may have taken a highly concentrated position in a stock that rallied hard. For example, if the fund manager invested 30% of the investor's capital in a speculative stock that doubled, whilst the rest of the portfolio returned zero, then this one stock would have provided the entire 30% investment return. Risky concentrated bets that happen to pay off can mask subpar investment performance across the rest of the portfolio and present significant risks for investors. These concentrated bets turn sour. Lastly, the risks taken by a fund manager at the stock level are an important consideration, though most of the time this is difficult to observe from an outside vantage point. Investment managers that make a series of bets on highly binary outcomes, where the fate of a company rests on, say, winning a contract, a lawsuit, or commodity prices rebounding, are likely to have a much riskier portfolio than the fund that has considered the value spectrum for their investments and restricted their portfolio to stocks with very limited downside. Applying this framework to the global fund offering shows that Montgomery Global Fund has achieved solid performance while holding relatively high levels of cash. We all want high investment returns, but we must be cognizant of the risks taken to achieve good investment performance. Thanks for watching, and don't forget to follow us on Facebook and Twitter.